Good morning, good morning, good morning, everyone. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. And P.I.L.L stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. And as we get ready to go into this new year, we want to understand how debt actually works and how we can make it work for us. I have Abdul on the stage this morning. Abdul, good morning to you, sir.
Hello, sir. How are you?
Excellent, excellent. So what brings you to the stage this morning?
Yeah, so basically, I'm the biggest drug dealer in Mexico.
All right,
I'm
well, get
looking
off
to
the stage.
invest
Get
in,
off my stage.
looking to
Get
invest
off
in
my
some
get
property
off my
and learn
stage.
about that.
Get off my stage. All right, get off. All right, we're going to
You
move
know,
you
trying
back.
to,
We're going to move you out of here. All right? So, listen. I will tell you, why do people do that? Why do people do that? I just do not know. All right. So anybody else that's serious that wants to know about how debt actually works, come on up to the stage. Raise your hand. Listen, I would love it if you could come up to the stage right about now and sit here and learn as opposed to staying in the audience. Why? If you're in Clubhouse, when you hit the stage, you invite more people in. All right. So let me go ahead and get my link ready so that you can take a look at what we're doing on YouTube. So when you get to YouTube, you can search for P.I.L.L Method and then go to our live session, and you can see what's going on. Okay, there we go, and paste that. There we go. All right, and we're sending that out to you. All right. So, do I have any questions to start out with? Because what we're going to be going over is what we need to understand about mortgages, student loans, credit cards to get ready for the new year. And the reason why that's so important, ladies and gentlemen, is because since 1936 was the first amortized loan in the US, the first self-amortizing mortgage in the US since 1936. And since that time, virtually no information has been given to consumers about how the doggone things actually work. And we're paying 75% more interest than we need to. Let's see, who is that? I got Kim that wants to come to the stage. Hello there.
Good morning. How are you?
All right, Miss Martinez, how are you doing?
I'm doing wonderful. Thank you. I actually decided to just join the stage. I've been following you ever since I had joined in with Colleen. And I'm here to learn. I'm here to completely learn. I am completely new to the real estate investing game and wholesaling. And I think this is just a perfect time for me to be introduced to this, especially moving forward and what it has to offer. I've been doing my research, watched a couple YouTube videos, and I'm ready.
Excellent, excellent. So we're going to invite Steve up. So listen, you're right. If you're getting into real estate investing, what you want is to gain equity as fast as you can for as little interest as you can. Listen, we all need to save money. We all need to save money, and we all need to save as much as we can. So we're going to teach you how to borrow money at a discount. So listen, I need as many people on the stage this morning as possible. The program goes much better with conversation than listening to me. There we go. Come on, Steve. Come on, you're up. There's Steve. Anybody else? Can I get 2 or 3 more people to come up to the stage and listen? And when you want to have a conversation, just jump right in. You may learn something today about how to borrow money at a discount. All right. Do you want to pay wholesale or retail for your money? Wholesale or retail? Put it in the chat. Wholesale or retail for your money. All right. So let's go ahead and see. We've got some folks on. We got some folks on line. We're live on YouTube, Facebook, Twitter, and LinkedIn simultaneously, along with the folks here in Clubhouse. Let's jump in. All right. So I'm going to share my screen here. So we need to share the screen. Share screen. We're going to share this screen. All right. And let me see here. There we go. And share. There it is. All right, folks, we're getting ready to put things on the screen as we speak so that you will be able to see what's going. Oh, I'm sharing the wrong screen, I think. Uh-oh. Hold on. I think I'm sharing the wrong screen. Let me change screens here. And present, we want to share, stop that and share a different screen. Present, share screen. And there we go. That's the screen we want. Screen 1, I believe, is the one we want today. All right. So I'm going to put my PowerPoint on the screen here and see if that. Oh, again, guess what? I've got 3 screens. Guess what I just did? I put it on the wrong screen the first time. I put it on the wrong screen the second time. I put it on the wrong screen. So I got one more chance to get it right. Okay, here we go. So you guys can see what's going on. All right, so we're going to eliminate that and then share this other screen here, present here, and share this screen. There we go. Entire screen. There it is. All right, so let's get into it. Now, I'm still looking for more people to come to the stage and ask questions anytime you want, but we're going to go from beginning to end. Listen, we're going to give you the whole story. Sometimes I just give bits and pieces, but now I'm going to go over the whole thing in detail as to why we need to spend more time understanding how loans work and how we can pay off not just the mortgage, not just the student loans, not just the credit cards, not just the car loans, but all of it can be paid off in an average of 7 to 9 years, depending on how much money you make and how much discretionary income you have. All right. It can be done. All right. It's all about not paying the interest. You don't need more money to get out of debt, ladies and gentlemen. You need to pay less interest. So let's put this on the screen. Let's go ahead and get started right now. So we're going to share this screen, add to the stage. There we go. And we're going to change and we're going to add one more camera as well. There we go. All right. So here we go. Let's get started. Okay. How to pay off mortgages and all other debt in 7 years. If you're new to the stage and you want to see what we're talking about, you have to go get a second, device, an extra phone, a computer or a laptop, a iPad or something, and then go to YouTube, and then you can see my screen. All right. I also put the link in the chat. Okay. I'd like to also put a link in the chat. So Kimberly says, do we need to go to YouTube to physically see you? Yes, you do. All right. Yes, you do. All right. Great. So let's go to YouTube so that you can see this without seeing the numbers. You know, I heard a presentation the other day. Somebody sent it to me. And they were saying things about mortgages and about borrowing and lending. And it seemed as though they were making good points. But guess what they didn't do? They didn't show the math behind what they were saying. We know a lot of stuff when it comes to borrowing and lending. We hear a lot of advice, and a lot of it, bad advice, comes up this time of year. We see it on TV. We see it on the news programs when they do a segment on using credit cards at Christmas. We see it on, they bring on gurus to talk about in this new year, we're going to be getting out of debt. But guess what? when they give you that advice and when they say things that sound right, they don't show you the math to prove what they're saying. We just accept it mainly because we've heard it over and over and over again. So we just assume it's correct. Okay. So let's get into this, and we're going to get into the math as to why what we're talking about is correct. How to pay off mortgages and all other debt in about 7 years. Okay. So here's our first slide. P.I.L.L method is the name of the company. P.I.L.L stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. And right now, we're live on Clubhouse, Facebook, LinkedIn, YouTube, and Twitter. And, and so, I mean, are you guys calling it X? Are you guys calling it X? Because I still call it Twitter. All right. So Kimberly is raising her hand, bringing her up. All right, Kimberly, I saw your hand. I see Juan in here. He's got a party hat on, which means he's been on Clubhouse less than a week. Thank you so much for choosing to be with us, Juan. Kimberly, how are you doing this morning? And maybe Kimberly, go ahead, Kim.
Okay. Happy Sunday, everyone. Thank you so much. My question is, I just purchased a home in June and wanted to know how soon could I try to pull out equity or do like a HELOC, or would you even advise that?
Definitely you want to get a hit. Do you have equity right now?
I need to double check on that. My interest, I have a conventional loan and my interest rate was 5.25.
Okay.
I just recently moved to Houston, Texas, so
Congratulations.
thank you. Thank you.
Well, no, you
Um,
need to have equity in your home to
okay.
pull that up, because see, you're borrowing money against the equity you have in the home.
Mm-hmm.
And so at a certain point, sometimes you need to build that equity over time
Okay.
due to paying the loan down and market conditions, which will increase the value of your home because of the surrounding comparables. When the houses in your area go up in value, yours should go up in value as well. So one of the
Okay.
things you want to check on is the two things you want to see is, do I have equity? And number two, do I really need a HELOC? May I ask why you're asking about a HELOC?
I thought that would be the easiest way to borrow.
The easiest way to borrow? To
Yes.
do what?
I want to invest and get other properties.
There you go. Now you're talking. All right. So listen, ladies and gentlemen, the reason why I asked Kimberly this is because the last thing you want to do, I will repeat this, the last thing you want to do is borrow money from a HELOC, using your equity to pay off other debt. Don't do it if you can possibly help it. It is the last thing you want to do, is take that and consolidate debt with that money. I know people preach it, they teach it, they're saying it's a good thing, but it is not. It costs you way more money than you'll ever save by lowering your payments. So Kimberly, great idea. You can take that money, and here's what you want to do. If you get that HELOC, remember, are you working with a seasoned investor to teach you?
Not a season. Well, yes, no.
Okay. All right. Well, keep this in mind. All right. Take that money. If you get money to invest, try to put down payments on properties so that you can get more than one, as opposed to using a lot of money on one property. Does that make sense?
Absolutely.
Okay, there you go. So that's my 2 cents. All right. And I would listen, I would learn as much as I can. It sounds like you're new to investing.
I am a new investor. Yeah.
Okay. And so are you familiar with Business Over Breakfast?
No.
Oh yeah. Business Over Breakfast is on this app. All right.
Okay.
And Byron Holman did you say you're in Houston?
I am.
And he's out of Houston.
Okay.
And he teaches people how to be investors with no money down.
Okay.
He doesn't like to use the bank's money.
Okay.
All
Well,
right.
I know. I think the starting November 17th, they had just passed the law
Mm-hmm.
in Fifth Ward
Okay.
in Houston, Texas. You can now build a fourplex on 5,000 square feet. So I
Oh,
wanna
okay.
move.
So
Yes.
listen, their program is called No Stingy Energy. Look them up on YouTube.
Okay.
And he's right there in Houston. And I can introduce you to later on. So if you go to, you know how to find my Instagram by clicking on uh, my bio.
Okay. The P.I.L.L method.
Mm-hmm. So you go down, and yeah, the P.I.L.L method is my Instagram. So message me, and then send me your phone number, and I
Yes.
will introduce you to. And then Byron could probably introduce you to their accelerator program, where they teach people how to invest with very little or no money down.
Okay.
Okay, Byron Holman. All right.
Okay. I just messaged you. Thank you so much.
You are so welcome. You're so welcome. All right, everybody. Listen, this is where you come to get advice. This is where you come to get good information. All right. So listen, let's get into this thing. Let's see where we are. Okay. So now, I'm going to go past that. All right. And all right. So my information can be found here, ice10k.com. ICE, the number 10, the letter K.com. Go there. All right. And here is my website is pillmethod.com, and here's my book, The Pill Method, A Better Way to Eliminate Debt. All right. And I got a question coming in from Denise Jones on YouTube. And Denise says, I'm new to investing as well. I have a great deal of equity in my property, and I would like help. I would let's see. I'd like you to help me with this as a seasoned investor, please. Okay, listen. All right, Denise, here's what I'm going to also do for you. Okay. And I'm going to put my business number in the chat. It's 256 886 1867. Please do not text this number. Don't text it, call it, talk to my um, uh, uh, people who answer the phone, okay? And then they will get you, they will have me give you a call back, all right? 256 886 1867. And we're going to put that in. Oh, come on, man. Let's get that out of there. There it is. That's my number. Or go to ice10k.com, ice10k.com, and contact us there, all right? You can find our email and everything there. So onward and upward, ladies and gentlemen. So here we go. All right. So 90% of the people you know with a mortgage will never pay off their home free and clear. 90%. Why is it that 90% will listen? Of all the people you know, how many people do you know that had a mortgage that ever paid one off? I don't care how old you are. Chances are it's less than 10% of the people you know. Count it up. Now, here's my next question. Why is it that we have a system where 90% of us fail? 90% of us fail. Okay? So, all right, Kimberly, why don't you go ahead and mute your mic there? All right. There we go. All right, so now here's where we're moving. We want 90% of us to succeed, not fail. 90% of us, we want to succeed and not fail. 30-year loans should pay off in 7 to 9 years on average. Now, some actually take longer, just a little bit longer, but at least it's not 30 years. Some actually do it faster than 7 years. But here's the thing. It shouldn't take 30 years to pay off a 30-year mortgage, because It is the interest that causes the problem. Listen, if all of your debt was 0% interest, is there any financial benefit to paying the loan off early? Put a yes or a no in the chat. Put a yes or a no in the chat. If all of your loans were 0% interest, is there any financial benefit to paying it off early? Lakeisha Watts says no. Eric Toombs says no. All right. A lot of people are going to say no. So here's the thing. Then why does every program out there, I don't care if it's Dave Ramsey, Susie Orman, you're watching other people on YouTube, on TikTok, or whatever they're talking about paying off the principal faster, how much you borrowed. They're talking about how fast to pay off the loan, but they're not talking about the real problem, the interest. You see, if all of your loans were 0% interest, there's no financial benefit. So the real benefit to paying off the loan early is the interest savings, correct? So how much interest can we save? You want to save all the interest that's mathematically possible for you. We want to optimize your interest savings by optimizing the use of your current budget. Those people who come to the P.I.L.L method with their current budget are able to pay off all of their loans in an average of 7 to 9 years without sacrificing lifestyle. This is what I mean. There are some programs out there like the guy in Tennessee. The guy in Tennessee teaches, don't go anywhere, don't do anything, drive a 30-year-old car, eat beans and rice, sell pizzas at night, and cut up your credit cards and take all of the money and throw it at the debt. With the P.I.L.L method, the very first thing on our list is live an enhanced lifestyle. Live well, save more money, and get out of debt. You can do all of those things simultaneously if you know what to do. The key to getting out of debt is not coming up with more money, ladies and gentlemen. The key to getting out of debt is paying less interest. Does that make sense? If we can pay less interest, then more of the money that we already have would go to pay off the loan, wouldn't it? And we're going to get into that. I promise we're going to get into that today. So here's the next thing. If you're new to the room, go to YouTube, search P.I.L.L method, and you'll be able to see what we have on the screen. You can do all of this that I'm talking about without refinancing your loans, without change to your current budget, without sacrificing lifestyle. You can live well. Now, here's where you will not hear this information. You will not get this information from your accountant, from your financial planner, and you will not get it from your banker. Please don't even bother to ask. Because what I'm going to teach you today is not taught at any level of financial education anywhere. I don't care. It's not even how an amortization schedule actually works. It's not taught in the Wharton School of Business. They'll teach you how to create an amortization schedule, but they won't teach you how to defeat it. They won't teach you how it actually works, how you can save money with that thing. Do you know the very thing that costs us so much money, you can turn it around and create wealth with borrowing money? I will show you how you can borrow money, how you can take your mortgage and create wealth with it. You don't have to refinance to a 15-year. You don't have to refinance at all. You don't have to lower the interest rate. You don't have to do any of that. The way that it's set up currently, we will teach you how to read it today and how you can start saving some money. All right. If you want to save more money, then that's with my program. But if you don't want my program, you don't have to get it. I have 2 years worth of videos that's going to save you more money than these people will right now. Even my free information is going to save you more money than Dave Ramsey is going to save you. Susie Orman, Jean Chatzky, she used to come on NBC, and Larry Burkett. None of them are going to save you as much money as the free information that you'll get from the P.I.L.L method, from my book, and from the free information. I'm sorry, my book isn't free. From the free information that you'll get on our programs on YouTube, Facebook, Twitter, and LinkedIn. That stuff stays up permanently. Okay? So, what's next? All right, here's why. The ability to read and defeat an amortization schedule is not taught at any level of financial education. It's not taught. So, if it's not taught anywhere, how can they teach it? So, Don, if it's not taught anywhere, where did you get it from? Is anybody asking that question? I'll tell you. Now, I've said it before, and I mentioned it in my book, that I have ASD, which is autism spectrum disorder. Some people call it Asperger's. Okay. So I'm mildly autistic. So when I look at an amortization schedule, I see things in pictures and patterns, not necessarily the math, but the patterns that show up for me. I see that in a way that if we do things in a different way, we can save money. But if we follow the plan that we've been given, it costs us a lot of money. And I'll break that amortization schedule down for you in just a few minutes. I see some new people coming to the room. Please raise your hand, come to the stage if you have questions. All right, raise your hand, come to the stage, and go to YouTube. I've got the link in the chat. All right, let me copy it again and put it down lower so it's easier to find. There you go. You can go to YouTube and see the screen, because you must see the numbers to understand what we're talking about. And if you can't see the screen right now, make sure you watch the replay later, because it will be up on YouTube. All right. Oh, and when you get to YouTube, would you please subscribe, like, and comment on the videos? It moves us up in the algorithm. All right. So the amortization schedule is not taught. So what's going on here? Let me show you this what P.I.L.L stands for: prepayment of principal, isolating the principal amount, leverage, and liquidity. Prepaying principal. When you give money to the bank before it's due, that's called prepaying the loan. Now, everybody knows you can do that. But what everybody doesn't know is how much interest you save by doing it. And I'm telling you, ladies and gentlemen, a small amount of money prepaid saves you a ton of interest. I'm telling you, you can literally give the bank back their money in a way that makes it impossible for them to charge you interest. If you want to know how to give the bank back their money in ways that makes it impossible to charge interest, put a number 9 in the chat. Put a number 9 in the chat if you want to know how to beat the bank at their own game, because I want to teach you today. You know, some people give you a big wind up and then says, "Oh, to teach you, you have to give us money." I'm going to teach you today for free. All right. Now, isolating the principal amount means you want to have the right amount to go to the debt in the right month, on the right day of the month, to the right debt. The average family has 13 different debts. Which one do we pay off first? Which one do we pay off last? How much money do we put on the debt? All of that can be a known quantity if you follow the entire P.I.L.L method. All right. So isolating the principal amount means figure out how much of your money you need to put on the debt at any time. Leverage means you want. Now, I need everybody to focus in on this right now. Don't miss this. Leverage means you want to pay the least amount of money that you have, not the most, the least amount of money that you have at a particular time, so that you can maximize the amount of interest you're saving per dollar. The least amount, not the most. When you're amortizing a loan, practically everything you know to do, we need to do the opposite. And I'm going to be talking about some of those opposites today. Like somebody asked me last night, we went to a Christmas party. Somebody asked me last night, well, Don, shouldn't we put a large down payment down? I said, never. I said it just like this: never, ever, ever, never, ever, 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 ever put a large down payment on a mortgage or a car. Never do it. I'm going to show you why today. I need somebody to remind me of that because sometimes I get going and I forget about stuff. But you need to know why not to put a large down payment on a loan ever. If you can afford to put 20% down, okay, don't put 20% down. If it's a conventional, put 10% and prepay the other 10%. It's still 20%. But if you prepay 10%, then you could knock off about 10 years off the loan. And sometimes, depending on the loan, save over $100,000 in interest you never have to pay because you prepaid with the money. Now, if you put down 10% to get into the loan and then take the other 10% and prepay, that's still 20%. But when you put that money down after you close, it knocks years off the loan and saves tens and hundreds of thousands of dollars worth of interest that you never thought you could save. So we're gonna get into that. Okay, leverage. We talked about liquidity is understanding all of your money and making all of your money work, whether it's your line of credit, your credit card, your income, the money you have in the bank, all of that. You need to understand the cost of all of your money. And I'm telling you, if you have debt, your most expensive money is not your credit cards. If you have debt, your most expensive money is the money you have sitting in the bank making 0.1%. That is the most expensive money you have because you're losing money by sitting in the bank. Your money is not even keeping up with inflation. The longer you have your money, the less it's worth. Your most expensive money is the money sitting in the bank making 0.1%. Crazy stuff. Crazy stuff. Cash is not king in this society. A wise use of somebody else's money is. Here is the culprit, ladies and gentlemen. Here is the formula that costs us so much money because we have never been taught how it actually works. I will teach you today how it works. All right? And you will know how you can save money. So if the bank is using this thing, here to make a lot of money, where is your algorithm to cut interest cost? Where is it? Do you have one? Do you think you need one? All right, let's start inviting some more people in. And I would love it if you raise your hand and come to the stage. Listen, I know people like to hear me talk, but man, I love having a conversation. Okay, here's what bank owners don't want you to know. We're getting closer. We're getting closer to learning. Here's what bank owners don't want you to know. Amortized interest is deceptive. The lower the interest rate, the harder it is to pay the loan off early and cheaper. The lower the interest rate, the harder it is to pay off the loan faster and cheaper. We're going to show you that as well. The amortized interest is deceptive. The interest rate you're quoted is not the interest rate you pay. The interest rate you're quoted is not the interest rate you pay. Let me give you an example of that right now. Here is a $500,000 mortgage. The interest rate is at 3%. We can't even get 3% right now. Okay. You're looking at 7.5%. But even at 3%, the payment is $2,108.02. Total interest paid, $258,887.20. That's 3%, ladies and gentlemen. Let me ask you, does 258,887 look like 3% of 500,000? Huh? Does it look like that to you? Let me show you something. When you pay this loan off over 30 years, the bank wants you to repay the 500,000 that you owe plus 258,887, and total repaid is 758,000. Do you want to pay 758,000 for your $500,000 home? I'm just asking. If you don't, you came to the right place. Okay. So here's what you need to see. Total interest paid as a percentage of principal is 51.777%. All 3% loans for 30 years, you will pay back 51% of what you borrowed if you're not careful. Yeah, 3% equates to 51% paid back. And it's not compound interest, ladies and gentlemen, it's amortized interest. Compound interest is when you pay interest on interest. This amortized interest means that every single time you make a payment, you have a brand new loan. Oh, yeah. Your mortgage is not one mortgage. It's actually 360 separate mortgages. And that's why it's so doggone expensive. And I'll show you in a minute. Here we go. Here's the principal borrowed, 500,000. This is at 4%. Now at 4%, you're going to pay back 359,000. Now already interest rates are a liar. At 4%, you're going to pay back 359,000. That's 71.87%. Okay? At 5%, you're going to pay back $466,000 in interest on a $500,000 loan. That's nearly as much as you borrowed. That's why the figure comes out to 93%. All 5% loans for 30 years on a mortgage, you're going to pay back 93% of what you borrowed. Isn't that crazy money? Isn't that crazy? Okay, so here we go. A 6% mortgage. You're going to pay back $579,000 in interest. That's more than you borrowed. That's one house for you and one house for the bank. Anybody here interested in buying a house for the bank? Anybody? Not me. I don't want to buy anything for the bank. I like borrowing their money because I know how to borrow it at a discount. And I'm going to teach you how to borrow it at a discount today as well. A 7% loan, 139.5%. On 500,000, the bank wants you to pay back $697,000 in interest. Don't you think it's about time we wake up from this nightmare? Oh my goodness. What are we going to do about this? We're going to teach you how to understand a loan every step of the way. No shortcuts today. No shortcuts at all. No shortcuts today. You're going to get the whole sauce. Okay? $300,000. I need you to check this out and see what happens to people along the way. This person borrowed $300,000 at 4.25. The payment is $1,062.50. In the first month, $413.32 out of this money went to principal. I mean, $413 went to pay down the loan. The rest of it went to interest. Look at this. Total interest paid on this loan in the first year, $12,652.24 just in interest alone. Total interest paid in the first 10 years. The first 10 years of having this loan, you're going to pay $115,428.11. The reason why am I showing you this? The reason why we pay so much interest is because we lose sight of cumulative interest, how much interest we actually pay over time. We're so focused on the interest rate and whether we can afford the payment, we lose sight of how much interest we're actually paying because we don't add it up. In our program, we're going to add it up. I'm going to teach you how to add it up for yourself by putting it in an amortization schedule that adds it up for you. I'm going to give you Brett Whistle today, and we use that as, it's not my program. I use it as a teaching tool, and I'm going to give that to you for free today. You can go online and do what I do here, okay? So, in 10 years, here's how much principal you pay down. $61,670.29. That's how much the loan is paid down by in 10 years, $61,000, but it cost $115,000 in interest in order to give the bank $61,000 to pay down your loan. I'm asking you to tell me, do you believe $115,000 is way too much to ask of anyone just to pay their loan down by $61,000? And I don't mean that's part of the $115,000. I mean it's in addition to. When you add up the $115,428 and the $61,000 that went to principal, That's a total paid out on this loan in the first 10 years of $177,098.40. Do you see how easy it is to lose track of how much money you're actually paying? You think you don't have money. You've got plenty of money. It's just that too much of your money is going to the wrong place. It's not paying back the loan. It's just paying interest. And we need to pay less interest. Okay, so here we go. Prepayment of principal amounts. We're going to learn how to prepay principal and what it actually means. And the first thing that you need to know is that the rules on how to save money on your mortgage is written in your mortgage. It's written in your mortgage. It's on the mortgage note page. Would you like to read it with me today? Here it is. Here's what it says in your, you pull your mortgage papers out today, and you will find this statement: the borrower's right to prepay. Now, every time I do this, every time I teach this, do you realize that somebody asks me at the end, can I really do this? Will somebody say something to me? Will they take away? Listen, it's the borrower's right to prepay. It doesn't say the borrower has to ask permission to prepay. It's your contractual right to do this, and no one can take it away. Nobody takes this away from you. It's written right into your loan. But what we're not taught is how to read it and understand it. We're going to read it and understand it today. First paragraph: I have the right to make payments of principal at any time before they are due. A payment of principal only is known as a prepayment. That's written in your contract. Written in your contract. When I make a prepayment, I will tell the note holder in writing that I am doing so. And this is what this means. However your bank wants to be notified of your prepayment, that's what you do. Not every bank or mortgage company wants you to notify them the same way. In fact, some make it so easy that you can go on their website, click on making a payment, and there's a line there just for principal payments only. You can put that money there and it will go straight to principal. That's how they are notified. Okay? So now some ask me, do I have to ask permission or do I have to tell them to put the money on principal? Only if you are including your taxes and insurance in your mortgage. All right. Could you hold on for just a second for me here? That noise was me turning off the heater in my office, in my studio. When I come into the studio in the morning, it's cold in here. So I had to turn the heat up. So I just turned it off. All right. So Z has something to say. All right. Let's invite Z up. Z, how are you doing?
Hey, good, and thank you, Ice. My question is, what you're talking about right now, I can see why people ask you, is that for real? And is there anything that is there anything that I would do that would make that not happen, like balloon payments or some other different types of mortgages that I might take out that would not allow me to write this in every month or whenever, and take advantage of what you're so graciously and generously teaching us. Thank you.
Okay, Z needs a round of applause. Because she actually asked the question. This is good. This is good stuff. Bring your questions up. Z, absolutely nothing can disrupt this. All right. So if you have a balloon payment, that means that you may have a 30-year amortization, but you may have a 10-year term. And there are loans that are written that way, and they're usually not residential but commercial. Okay, but you can have a balloon payment, meaning after 10 years, the rest of the loan is due. But the borrower's right to prepay can actually help you with that. Let's just say, Z, that you have a balloon payment due in 10 years. What happens if you pay the loan off before 10 years? How they meant to get you, you've already got them. The loan is already paid off, so there's no residual, there's nothing left. Most of our clients pay off in 7 to 9 years. So if you have a balloon payment due in 10 years and you pay the loan off, the balloon payment goes away. Does that make sense, Z?
Oh yeah, that makes a lot of sense, and I'm so grateful that I don't have a balloon payment. and I'm just like so thankful that I'm learning this. I'm not even licensed yet. I'm in classes, so I really appreciate you. And yeah, that's very clear. And bravo, like I didn't know that that was written into every mortgage that you could prepay only on the principal, because why would you overpay your taxes or insurance?
Exactly,
So,
exactly. So you say
Word.
you're taking classes for what?
Just for the real estate salesperson, if I join NARS, I'd be a real estate agent. So
Okay.
that's where I've started. Yep.
Okay. How far into this are you?
The course study in terms of the face-to-face Zoom is completed, and now I'm just working, studying flashcards and the mathematics of what's going to be on the state and on the federal exams.
Let me ask you
Yeah.
something. In all that so you've done the coursework already. You're just getting ready for the exam.
Yes.
Did they go over how to read an amortization schedule?
No.
See, people don't believe me when I tell them that. That the very thing that you guys use to help people get into a mortgage. I'm gonna sell you a house, right? But you're gonna have to get a mortgage to get the house. But you, as a real estate agent, you're not taught how a loan actually works. And ladies and gentlemen, if you are an MLO, a mortgage loan originator in here, you also know that no one taught you how a mortgage actually works either. Your real estate agent, neither your mortgage professional, none of these people were taught how a loan actually works. Isn't that something? How about that?
Yeah, I mean, there is a portion that talks about the mathematics of um, um, insurance and taxes and this kind of a thing, but I have not. Only one of the teachers did show us, because he was like, "Well, let me show you one of these documents that you will be using." But the thing is, it is what it is, and it's an online school, and it is very bare bone to get people to pass the exam, and then they, of course, like myself, I'll have to be working under somebody, and then I guess some of it's learn as you go, which honestly, it kind of scared me, because I'm like, well, I don't really think I should be learning when somebody wants to buy this big old house, but I just figure I'll find a way, I'll figure it out, and I will be of good service to them.
Listen, this is great. You start where everybody else started, but you're going to be ahead of the game just from this class alone today. Thank you for coming to the stage, Z. So listen, let's get into finishing up this second paragraph, ladies and gentlemen. If you're new to the room and you want to see our screen, go to YouTube so that you can see this. I see a bunch of you in here on YouTube already. All right. So, but listen, put your comments in, put your questions in. All right. Good morning to everybody. Good morning. Good morning. Let's get started. All right. When you make a prepayment, you tell the note holder. Okay. Now you can make a full prepayment, meaning you can pay the whole loan off, or you can make partial prepayments, meaning you can pay in chunks. I mean, you can pay an extra 10 cents on your mortgage if you wanted to, or an extra $1, an extra $5, an extra $10, an extra 100, an extra 1,000. You can pay extra anything you want. Okay, that's called a partial prepayment because you're not paying off the entire loan. Okay, now here's the good part. Without paying any prepayment charge, they will not charge you to prepay. There are no prepayment penalties on residential property in the US. So don't even worry about it. And even if it was a prepayment penalty, guess what? You're going to know, because if you're into commercial properties, they do use prepayment penalties. But you need to understand that you can know how much interest you're saving by prepaying, and then you find out what the penalty is. And 90% of the time, the penalty is really small compared to how much interest you can save, because no one is talking about how much interest you're saving by prepaying. They're only talking about the penalty you're trying to avoid. Oh my goodness. Keep that in mind. All right. Here's the third and most powerful part of this, and then we'll jump in. The note holder, that's you and me, the note holder will use all of my prepayments. How much of my prepayments, everybody? The note holder will use all of my prepayments to reduce the amount of principal that I owe under this note. What did I just say? I'm going to interpret that for you. All of your money that you use to prepay goes to pay down the principal, meaning none of that money, and I will say it one more time, none of that money can be used to pay interest. And you're going to see how powerful that is. You're going to be able to create equity for free just with this sentence right here. The note holder will use all of my prepayments to reduce the amount of principal that I owe under this note. If I make a partial prepayment, there will be no changes in the due date. So it doesn't change anything to prepay, right? If there's no changes in the due date or in the monthly amount of my mortgage, your mortgage stays the same and you have a mortgage payment every month. But the way that we do it, instead of having a mortgage payment for 360 months, how about having a mortgage payment for 84 months instead? I love it. Okay. I love it. 84 months. Okay. So here we go. Here's the thing. This is the best part. This is the best part here. The part I just read. There's no changes in the due date, no changes in the monthly payment. So don't think you can't get ahead on your mortgage. So forget about that idea. But unless the note holder agrees to writing to those changes, and that's when you get your loan either refinanced or you get it reissued some kind of way. You have to literally change the contract to change this. But by prepaying doesn't change the contract. You will pay interest as long as you hold their money. So have you ever rented a car for more than a week? Have you ever rented a car for more than a week? And they will tell you, well, if you keep our car for 2 weeks, this is how much you'll have to pay us. But for some reason, you had to go home early and you return the car after a week. Did you have to pay 2 weeks worth of rent? No, you only paid 1 week worth of rent on the car. Money is the same way. You're buying the money. So as long as you have their money, you will pay. Return it early, you don't have to pay. It is that simple. Now, what we're going to do is break it down so that you can see. Now, I'm getting ready to show you right now how to read an amortization schedule. All right. Here is what you need to do. And this that I'm getting ready to teach goes across all loans, your mortgage, your credit cards, your student loans. The basic information is the same for all loans, all of it. Okay. So here's what you need to understand right now. Pay close attention. Replay this over and over again until you get it. Because now you're going to know why bankers do not want you to know how easy it is to save interest. And it is not because the banks make money on interest. If you have a loan, if you have a mortgage, Usually within a week or two, what happens? Do you get a notice in the mail that somebody's already bought your mortgage? That's how your bank or mortgage company makes money. They sell that mortgage on the secondary market. They sell it at a premium, and that's when they make their money. The investor that bought your mortgage says, this is great. They got to pay me all of this interest for the next 30 years. There you go. That's what happens. And the reason why no one wants you to understand how this works is because if you pay that loan off early, the investor doesn't make the kind of money they wanted to make. And that investment doesn't look as attractive to them anymore. And they will sell fewer mortgages on the secondary market. There's no bank in the country that can afford to have all the mortgages that they have on their books. They can't do it. It's impossible. They don't have that much money to lend out. So what do? They lend out, they set up the mortgage. You pay them fees to set it all up, and then they sell it on the secondary market for more than they loaned to you. That's how they make their money. And then the real estate investor says, these people don't know how a loan actually works. So they will pay me all the interest I'm looking for. This is what you need to know. Here goes. Here goes. Get into it. If you want to know how to read it or read a mortgage, put a number 7 in the chat right now. I'm getting ready to teach you. If you want to know how to read this and how to beat it, put a number 7 in the chat right now. Okay? If I don't see 7s, I ain't teaching. I don't see 7s, I'm not teaching it. Okay? I've been here, listen, I've been here 59 minutes, and now it's time to learn. Okay, now the 7s are coming in. Now the 7, okay, listen, online, put a 7 in online. The 7s are coming in on Clubhouse. If you're online, okay, now the 7s are coming in online. All right, somebody, now the 7s are coming in online. Because see, listen, I wasn't going to teach it if you weren't listening. Okay, here we go. Here is a $200,000 mortgage at 6% over 30 years. Here's the payment. It's $1199.10. Here is what you get when you close on this loan. They're going to tell you that you need to pay them $231,676 in interest on this loan. Meaning, once you pay it all back, thank you, Denise. Thank you, Keisha Watts. I see you. The $231,676 for a total of $431,676. Do you want to pay $431,000 for your $200,000 home? Of course not. Of course not. Okay. Total interest paid as a percentage of principal. Here it is. Here's your true interest rate, 115.838%. 115%. You would think that would be illegal. Now, I'm going to tell you why this is a good thing. I'm going to tell you why it's a good thing. I'm going to tell you why it's good. Anything that you see that the bank offers you and it looks bad is actually good. Anything that they teach, anything that they want to give you that looks good is actually bad. Oh, yeah. Like lower the interest rate, lower the term, buy down the rate, refinance to a lower rate. Anything that looks good is actually bad. Anything that looks bad is actually good. And I'm going to show you right now. Here's how this payment breaks down. $199.10 goes to principal. $1,000 goes to interest. Does that look bad? You better believe it looks bad. I just paid $199, $1199.10, almost $1,200, and only $199 of my dollars went to principal, while $1,000 goes to interest. Let's say we make that payment in January, $199.10, and I'm paid down to line 1 on my amortization schedule. I now owe $199,800.90. The algorithm that I showed you just a few slides back makes sure that the amount of money going to principal, they control. It's called the rate of change. In this case, the rate of change is so small. That means to pay back $200,000, you have to give them a ton of the principal payments to add up to $200,000 out of the $1199.10 that you just paid. So a small percentage of the money you paid actually moves the needle on how much you owe. Therefore, you have to pay them again and again and again to get enough of these principal payments to pay back the loan. And the part that doesn't pay back the loan, they count that in the interest column. Now, when a real estate investor buys your mortgage, here's what happens. When they buy your mortgage, when you make a mortgage payment, they get the entire payment. If your payment is $1,199.10, they get the whole thing. Yep, they get the whole thing. Now, why are we looking at principal and interest then? We thought some of that money went to principal. We thought some of that money went to interest. Nope, it does not. The investor gets the whole thing. Then what's the principal and interest about? The principal is a math problem. And the math problem says, based on the math, we're going to reduce the amount you owe under this mortgage by $199.10 so that we have to do the math again so that you will have to pay again. All right. So because you owe less, then the next mortgage payment, $200.10 goes to principal and $999 goes to interest. $201.10 goes to principal, $998 goes to interest. And so while you're paying $199 and $200 payments to principal, they get, listen, they're saying you have to pay me 360 times so that I get enough, you pay your loan down enough so that it zeroes out the loan. You're working to zero out the loan. Therefore, the real estate investor says, as long as you're working to zero out this loan, I keep getting a payment of $1199.10. And it's going to take you 30 years if you do this. And by the time you've paid me all of my principal payments, I will have received in total over $400,000 from you while you're trying to pay off the principal. Wow, wow, wow. Jimmy B says, if you pay 1/12 extra on your mortgage payments, that's an extra payment every year. That's right. But why wait? Why wait every year? We're going to show you something better than that, Jimmy B. Listen, what you're describing is like a biweekly payment. And listen, when I first heard about biweekly payments, I thought it was the best thing since sliced bread. You're actually paying one extra payment a year with a biweekly payment. Yeah. With the P.I.L.L method, you'll be able to do more and do it cheaper, and you won't feel a thing. Watch this. So if we make a payment in January, and if you're new to the room, I see some people coming in. If you're new to the room, go to our YouTube channel and watch this so you can see it. Go to P.I.L.L method, go to YouTube on another device, and you'll be able to see this while you're listening to me here. Okay. So in February, $200.10 goes to principal and $999 would go to interest. And therefore, I'm paid down to line 2 in February. That's how it works. Anybody wants to ask a question about this? If I go too fast, make sure you raise your hand, come to the stage, and I'll answer the question. Now, let's go back to January. I make January's payment. Okay. I'm going to make January's payment. And if I make January's payment, I'm all done. My February principal payment is $200.10. Here's my question. Do I have to wait till February to pay the bank that $200.10? Put it in the chat. Put it online. Do I have to wait till February? Based on what I read, your right to prepay. If you have $200, do you have to wait till February to give it to the bank? Yes or no? All right. Eric says no. Steve Mack says no. Anybody else? because we read it before. Remember, you can prepay this loan. And if you give them the $200 early, what happens to that $200.10? We read in the paperwork that all of it goes to reduce the amount of principal that I owe under this loan. Keisha Watts online says, no. Listen, capital letters, no. $200.10. So all of that would go to my principal. So I'm paid down to line 2 on this schedule in just 1 month. Isn't that great? So I made my regular mortgage payment. I gave them the $200.10 early. I'm paid down to line 2 on the amortization schedule, which means my next mortgage payment for February, because remember, we can't get ahead. We always have a mortgage payment because we read it. My next mortgage payment is actually on line 3. If we do this according to the bank, you realize to remove every line on this amortization schedule, I have to give the bank $1,199.10 if I pay according to their schedule. We just learned how to remove one line from this amortization schedule with only $200.10. Line 2 is gone. We're now jumped down to line 3 by giving the bank $200.10 early. And if I do that, ladies and gentlemen, what happens to the $999 in interest on line 2 if I pay the principal amount early? What happens to that $999? Does anybody know? What happens to that $999? It's canceled. You never have to pay it. Boom. Now, here's what I need you to see. Every time you make a payment on this loan, according to the timing the bank gives you, you have to pay them to get your equity. When you pay down this loan for $200.10, that's potential equity. You're creating distance between how much you owe and how much the house is worth. Okay? How much you owe and how much the house is worth. You've just increased how much, you just decreased how much you owe by $200.10. Jimmy B says, does it disappear or is it lower? Okay, that's a very good question, Jimmy B. Does it disappear or is it lower? Because it looks like $1,000 goes to interest the first time, $999 goes to interest the second time, and $998 goes to interest the third time. Is it just lower or does it disappear? Jimmy B, you know I have to answer your question, I got to leave my PowerPoint here and show you the numbers. Now, you may not have been here at the beginning, but I told everybody else at the beginning, when somebody is teaching anything like this, they have to show you the numbers. So Jimmy B, because you asked the question, guess what? I got to show you the numbers. So we're going to get out of this. We're going to get out of this. Okay. We're going to get out of this and go to an amortization schedule. And I'm going to put it on the screen right now. And we're going to go over those numbers before I go back to teaching the rest, because you asked the question. All right. So here is, we're going to go to Brett Whistle. And I right now, because I'm going to Brett Whistle, I can easily give you, I'm going to copy this right here and I'm going to paste it so that you can have that. Uh-oh, that's the wrong link. Doggone it. That's the wrong link. Sorry, that's the wrong link. That's the link to the YouTube. Okay, let me copy that and let me hide this. Okay, I got to get so I can paste that and give it to you guys. All right. So, and there it is. Okay, here it is. So we're going to paste that. Here's the link for Brett Whistle. There it is. Okay. And you can do this yourself. It's great stuff. It's great stuff. All right. So we're going to put in the $200,000 mortgage. Okay. And we're putting it in at 6%. We're going to click on show amortization schedule and we're going to calculate. See, the payment is $1199.10. Let's get rid of some of this advertising. We don't need to see that. $1199.10. Remember what I told you, that you're going to pay back $231,676 in interest for a total of $431,000. And what is the total interest paid as a percentage of principal? Just what I said, 115.838%. All right, let's scroll down to, all right, I don't want to get out of that. All right, let's scroll down to payment number 1. Here it is. Okay, let's teach you how to do this. Okay, when you have a mortgage, they're taking that 6% interest. Here's the number the bank uses. They take your interest rate, 0.06, and they divide it by 12. They divide that number by 12. That's the number they use, 0.005. 0.005. And they take that number and multiply it by your unpaid balance. So if you take that 0.005 and multiply it by $200,000, you will get the first interest payment. So we're going to multiply this by $200,000 equals $1,000. That's how they figure your interest cost. So if I pay according to how they want me to do this, I'm paid down to $199,800.90. They're going to take that 0.005 and then multiply it by this number. It's going to give me the $999 in interest. So let's do that. 0.06 divided by 12 equals 0.005, and we're now going to multiply it by $199,800.90 multiplied by $199,800.90 equals $999. This number is the only number in the universe in a 6% mortgage for 30 years that can give you $999, because this is the number the computer saw. All right, because if you pay according to their schedule, this is how it has to be. But here's what we did. We gave them the $200 early, which made it impossible for them to charge us interest. So now the computer saw this number, $199,600.80. It didn't see this number because when I paid my mortgage, I was paid down to here. I gave them the $200 early in January, so I'm paid down to here in January. So at the end of January, they had to use this number to calculate my next interest payment. So here's my next interest payment. So it's the 0.005. Oops, delete that, put my 5 in. And now I'm going to multiply it by the $199,600.80. We multiply it by $199,600.80 equals $998. I can listen, if this is what they see, I can only pay this number. I skip right over this one. Does that make sense, everybody? Does that make sense? Listen, when somebody is teaching this thing and they're telling you what you can do and how to save money, and they don't show you the math, you just need to run. Just run. They need to show you that what they're talking about is true. Okay? So I got a question here from online here. It says, do you have to pay according to the amortization schedule, or can we just pay? Yeah, you can pay any amount extra. Any amount extra. And we're going to go over what happens when you pay any amount extra. We're going to go over that today. All right. There's a lot to learn. I told you no shortcuts today. We're getting ready to go into the new year, and I usually break this thing up over several meetings, but you're going to get it all at one time. And you're going to have to watch this thing over and over and over again on YouTube, Facebook, Twitter, or LinkedIn to let it sink in. Okay? I don't mind giving it all to you at once and not breaking it down, because we're getting ready to go into the new year, and we don't need to go into the new year not understanding how the debt works. Okay? Does this now make sense, Jimmy? Okay? Does it make sense? All right. I hope it does. All right. So here's the next thing you need to go. I'm going to go back to my PowerPoint now. Let's put that back up on the screen and continue. All right. So now I have just done this. All right. And I've just eliminated $999 in interest I never have to pay. Isn't that good? Normally, it cost me to give the bank $200, and it cost me nearly $1,000 just to give it to them. I just got my equity for free. Yeah, that $200 in equity I normally would have to pay for, I just got it for free. What if we did this? Okay, what if we did this instead? I just paid my mortgage payment. Do you know how people say you got to double up on your payments to get out of debt? And we think, if my payment is nearly $1,200, I got to come up with another $1,200. No. The principal payment is what you attack the loan with. The principal payment is what you attack it with. And the lower the principal payment, the better off you are. Not higher. The higher the interest rate, the lower the principal payment. And that means the amount of money I can prepay, I don't have to come up with as much money to kill a lot of debt, to kill a lot of time, and to kill a lot of interest. So what if we did this? I make my regular mortgage payment, and now I'm going to give the bank the next 3 principal payments. That's $200.10, $201.10, and $202.10. All right? What happens if I give the bank that? What happens to the next 3 interest payments, $999, $998, and $997? What happens to them? For $603.30, that could be sitting in my bank, making 1/10%. I could take that money and apply it to this mortgage and kill nearly $3,000 worth of interest I never have to pay, knock off 3 payments I never have to make. And my next mortgage payment is on what line of this schedule, ladies and gentlemen? I need you to put it in the chat if you've been watching. What line am I on in my schedule? I was on 1. I gave them 3 principal payments. Now what line am I on? Put it in the chat. What line of the schedule am I on? Eric Toom says line 5. He's exactly right. I am on line 5. Line 5. And so normally it would take 4 payments of $11.99.10 to get there. I just made 1 payment of $11.99.10 and then gave them only $600. And now I'm on line 5. And that means I didn't have to give them the $3,000 in interest that they were looking for. Does this make sense, everybody? If you like this information, put some fire emojis in the chat if this makes sense to you. Put some fire emojis in the chat if this makes sense, if you like this information that you're getting right now. All right, Kim Martinez, she's going to be taking her test soon. Kim, I'm going to give you some stuff that's going to, you are going to be queen, not for a day. You're going to be queen not for a month, not for a year. You're just going to be queen of the mortgage syndicate right now. You're just going to be queen, okay? Because you're going to be able to teach your people stuff about mortgages no one else is teaching. You're going to be able to save your clients a whole lot of money, and they're going to keep coming back to you buying house after house, because our clients pay off a mortgage in about 7 years. If you can teach your clients how to do that, they're going to come back and buy another house because they're going to put a renter in this current house and buy another house for them. They're going to pay that one off in about 7 to 9 years, maybe even 5, because now they have rent coming in. They're going to pay that one off and put another renter in that. They're going to keep coming back to you. Boom, 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 because you're teaching them stuff that they need to know. All right. So let's go. Let's listen. Let's go to the next thing. Why do we need to study this? Because we need to focus on interest cost, not interest rate. If we're following interest cost, ladies and gentlemen, we can do something about interest cost. Interest rate is a liar. So Don, what if I don't have, you know how many people say, Don, I don't have the extra money to put on my loan. You don't need extra money. Can I give you a little hint? Something that's easy to do? For all of you that want the free version of this, now you can do business with us, and I guarantee you, you're going to save so much interest using our full program. You don't care how much you pay for the program because it's a lifetime program. You get to use it over and over again. But if you want the free version, here's what you do. Make sure you're tracking how much you're making and how much you're spending. Make sure you track how much you make and how much you spend. When you track your spending, you know what your budget is. I'm not saying tell yourself you can't do something. I'm just telling you, just write down what you are doing so that you know when all your bills are paid, and so you'll know how much money is left over. Most people have no idea how much money they have left over because they're not tracking how much they're spending. Take that money that you didn't spend, because all your bills are paid, all your food is bought, electricity is paid, cell phone is paid, you're putting money away for savings, you've had some fun because you're scheduling how much money you can spend each month just on you to have some fun. It's all in your budget. You've written it down. Here's how much money you have left. Put that in your savings account. Put it in your savings account. Keep it there until you build up some cash. Take some of that cash out and put it on the debt. Here's what you could do if you do something like that. Let me give you an example here. It's called the power of the penny. We just learned if we take $200 from that bank account, remember, after all the bills are paid, you're sticking some money in savings. What if you take 200 of those dollars and put it on this loan? It saves you about $1,000, right? So what would happen if you take half the money, half the $200, and apply it to the debt? You would save half the interest. Ladies and gentlemen, is it still worth it if I put $100 on principal on this loan that I save about $500 in interest? Is it still worth it? Is it still worth it? What if I take the $50 and put it on this loan? Did I just save $250 worth of interest? Did I just save that? Oh my gosh. $25 applied to principal saves $125 in interest, $12.50, and keep on going down. So listen, $3.13. If you gave me $3.13, ladies and gentlemen, and I gave you back $18.75, how many times would you give me that 313? How many times? Until I cried uncle? Do you realize when you give the bank an extra $3.13 on this mortgage at this juncture, it makes it impossible for them to charge you $18.75 of all the interest they wanted to charge you. They have to take off $18.75 here. That's how you need to look at this mortgage. Oh, and I'm not done. I'm not done at all. I pick up pennies in the parking lot. Listen, if you're with me and I see pennies in the parking lot, I hope you're not embarrassed because Don's picking them up. I am picking up the pennies. So, because $1.56 saves me $9.38. Listen, let's drop down to 20 cents. It saves me $1.18. Even a penny saves me 7 cents interest on this loan. Listen, folks, you don't need a lot of money to save a ton of interest. and save you time on your debt. I hope this makes sense to you. All right. So here's another thing I want to show you. All right. Before we move on, because I'm not seeing any hands raised. I'm not seeing anybody asking any questions. All right. But I do see fire emojis. I do see fire emojis. Kim says, I received this. Oh, and Paris says, good Sunday. Good Sunday. Charles Mills puts a fire emoji in the chat. David Baker, fire emojis in the chat. So listen, I'm going to show you something else here. Okay. What if you're fortunate enough? Let me ask you something. Let me ask you something. If you're fortunate enough to take, if you're looking at cumulative principal here, you got $2,456 and a penny. Cumulative principal, that is the third column. This is how much principal you pay down in 1 year. All right. And I'm going to show you the math to prove it. Okay. I'm going to show you the math to prove it. $2,456 and a penny. All right. $2,456 and a penny. That's how much principal you pay down in 1 year if you add up all the principal payments here between one. And it cost to move your loan from $200,000 down to $197,543.99. It costs $11,933.19 to move it from point A to point B, from 200,000 down to 197,543. Okay. Now, if it costs that much to do that, my question is, their bank is charging me nearly $12,000 to give them $24,5601 towards principal. They're charging me that much money. Do I have to pay the $24,56 over 12 monthly installments? That's my question. Do I have to pay the $24,56 in 12 monthly installments? Yes or no? Come on, people, talk to me. Yes or no? Do I have to pay it over 12 monthly installments? Steve Mack says no. Eric Toom says no. Charlie Mills says no. Listen, if I have it, Kim Martinez says, no, you don't. Okay, listen, she's getting bold with her statements now. Kim, talk to me this morning. Open your mic, can you?
I am here.
Kim says, no, you don't. So why are you so emphatic about that now?
Honestly, like with everything that I'm learning, I'm sitting here going back and forth between my notes, everything you're saying, following everything that's on the screen, and everything is just making sense now. And I'm just like, really sitting back. I'm just realizing, we really don't. If we only had this knowledge before, for me, I'm like, I wish I had it before, but I'm so grateful for learning it right now. I am so grateful.
Well, thank you for being here. Okay. So if I had that 245601 and I applied it on line 1, they would have to subtract it from what I owe. I could be paid down to line 12 on my amortization schedule in just 1 month. Then what would happen to all the interest payments between line 2 and line 12? Yeah, that part. Gone. Zippo, they're out of there. I'm paid down to here in 1 month instead of 12. And it makes it impossible for them to charge me interest. Folks, do you just love this? Do you just love it? That the rules to beat the bank at their own game was already written into the mortgage. You can use your current mortgage structure and beat it because now you know. And the reason why you know is because if you use this amortization schedule, Brett Whistle, you can actually see how much interest we're saving and how much interest they're charging you. The reason why we don't is because we lose track of how much interest we're actually paying. It's called, in my book, I call it interest consumption. How much interest are you consuming each month, ladies and gentlemen? The average family consumes about 35 to 39% of the have 35 to 39% interest consumption on. They pay that much of their take home pay. 35 to 39% of their take home pay is spent on interest alone. Period. That's why And I don't care how much money you're making. I don't care how well you're doing. That's still too much money to pay on interest. 35% of your take home pay. And we're concerned about what? Taxes? You're going to pay way more interest in life than you'll ever pay in taxes. But we have so many ways to avoid taxes legally. No one is talking about how to avoid paying all this interest. And just from this class today, you've learned something today about this. Now, I'm going to teach you something that I told you about. I'm going to teach you something about what happens when we refi. Now, how many have heard marry the house, but date the rate? Marry the house and date the rate. How many have heard that? Marry the house, date the rate. When the interest rates drop, you can always refi. Okay? You can always refi. Let me show you a little bit about this, and then I'm going to leave the PowerPoint, and I'm going to put the math on the screen so that you guys can see it step by step, because I said I'm not going to take any shortcuts today. This is called refi fantasy. Refi fantasy, and I'm going to show you just one or two of the 6 or 7 ways mortgage companies make money on refinancing. I need you to remember these 2 questions. If you are saving money by refinancing, who's losing it? If you are saving money by refinancing, who's losing it? Yeah, I know you don't want to say the bank. Because listen, both of you can't be winning here. And why would your bank ever who has you locked into a higher interest rate, why would your bank ever offer you a lower interest rate and say it's time for you to save money so we can lose money? Come on, folks. It never even occurs to us. We just say that listen, all the experts say if you can get 2 points off your loan, it's time to refinance and save money. Yeah. Think about it. Really? No. Watch this. I got that $200,000 loan I'm talking about, and they're offering you 3%. Now they're going to offer, listen, you're going to cut this thing by 3%. They're going to offer you 3%, and they're going to roll in the closing costs. Should I take it? All right. Watch what happens when you roll just one thing, just one way of rolling in the closing costs to this loan. Here we go. $200,000 of principal, 6%, $1199.10. And we refinance usually about 5 to 7 years. Let's say we're in the loan for 7 years before we refinance, and you don't know anything about the P.I.L.L method. All right. And here it is. In the first year, you've already paid $11,933 in interest. Okay. In the second year, you've only paid the loan down by $5,000, but you paid $23,714 in interest. That's just in 2 years. In 7 years, that's 84 payments. In 7 years, you've paid the loan down by $20,721, and you've paid $80,000 in interest. Folks, that's $100,000 all day. You paid out $100,000, and out of your $100,000, you paid your loan down by $20,000. So the investor says, yeah, you got to keep on paying me to get to that $200,000. And by the time you're done, I will have received over $430,000 of your dollars. That's what the investor is saying. But now you're paid down to $179,278.87. That's where you're paid down to. And now the experts are saying, take that money, take what you owe now, and now refinance this loan, because now you can get 3%. Now you can get 3%. And that's what we're told, right? And we all do it. And listen, if somebody said, I'm going to give you a 3% loan, most of us would jump on it with both feet. I'm going to show you what happens when we do. All right. So we got 100. Remember, we were at 179,278, and we're at 179,278. And I only put in $5,000 worth of closing fees. Right now, to close on a refinance is somewhere between, on average, $8,000 to $10,000, and I've seen it as high as $17,000 to refi. Okay, so now we're going to take that 179,000. We're going to add 5,000 to it. It's 184,278.87. That's our new balance at 3%. But guess what? They give us a brand new 30-year loan. You think it is the interest rate that is the driving force in lowering your payment, when in fact, it's taking what you owe and dividing it by a new 30-year loan. So if you've been in this loan for 7 years already, you refinance it, you get a new 30-year loan. Folks, isn't that a 37-year loan? Isn't it? Just think of, I'm just add it up. 37 years now I'm going to be in this mortgage at least. Because I didn't know anything about the P.I.L.L method, right? All right, watch this. So now my new monthly payment is $776.93. I'm smiling as I go out of the bank. I've just signed my papers. I've closed on this new loan. I'm smiling. And the bankers are smiling as well. How can both of us be happy? Watch this. 184,000. Now my total interest paid is going to be another 95,000. And I dropped it down to a 3% loan, which is still a 51.777% loan, 51.778 in this case. Okay. 51%. That's what all 3% mortgages are. We went over this earlier. Watch what happens with this new loan. My old loan, I was paying $1199.10. Here's my new loan, $776.93. Folks, that is a $422 a month savings, and that's how it's sold. Okay, you're going to be able to save $422 a month. That's how they sell it. Now, remember you added $5,000 to your loan to close it out. I want you to see, even at this new low interest rate, how long it takes to pay back the first $5,000 and what it costs. In the first 4 months of this new loan, at the new lower interest rate, at the new low payment, in the first 4 months, take a look at cumulative principal. You pay this loan down by $1,269.68. Folks, that's the $5,000 you rolled in. We got to pay off the first $5,000 just to get back to where you were before you refinanced. So in 4 months, you've only paid it down by $1,268. But look how much interest you paid on $1,200 on that $5,000 you borrowed so that you can refinance this loan to get a 37-year loan to get a lower payment. In 7 months, you've only paid back $2,200 of the $5,000 and paid $3,000 in interest. After 10 months, you've only paid back $3,198 of the $5,000 you rolled in and paid $4,571 in interest on that loan. 13 months, you still haven't paid it back. But in 16 months, you finally paid back the $5,000 and paid the bank $72.75.16 to do that. Your refinance in total, if on this loan, costs $12,430.88 in the first 16 months so that you can get a lower payment and a new 37-year mortgage. Folks, tell me, is it worth it? Let me ask you, if I lend you $5, if I lend you $5 and I say, pay me back the $5 plus $5 in interest, what interest rate am I asking for? Put it in the chat. I lend you $5. You pay me back the $5 plus $5 in interest. What interest rate am I asking for? Anybody know? What's the interest rate there? Oh, okay. BJ says 100%. Eric Toom says 100%. You're absolutely right. This mortgage is at 3%. It took me 16 months to pay back the $5,000 that I borrowed and $7,000 in interest. $5,000 paid back and $5,000 in interest. Isn't that really 100% interest I got fooled into? Paying the bank 100%, over 100% interest to roll that money into the loan. Didn't I just do that? Listen, folks, I'm not making this up. Listen, you're seeing it on the screen. It happens every day. People refinance, rolling that, and they don't even realize they're paying 100 to 200 to 300 and sometimes 400% interest on their closing costs because they rolled it into the loan. That's just one of the ways out of 7 ways that the bank makes money on refinancing. Kim Martinez says, wow. Kim, Kim, would you have believed it if you hadn't seen it? Remember, I talked to you about down payments. Remember, I said you don't want to put a large down payment on the loan. Here is an example of why you don't want to put a large down payment on a loan. This is called down payment deception. Down payment deception. We've been in here 1 hour and 43 minutes. I promised to teach you this. All right. I didn't hold. Am I holding anything back? Is there anything that you would like to know that I'm not teaching? I'm not holding anything back on this information. It will be up forever until YouTube goes away. You can go back and get this information. If you're new to the room, go to YouTube so you can see the presentation right now. And it'll be up there until you decide not to watch it anymore. Okay. Down payment deception. Watch this. This guy lived across the street from me, used to anyway. He's building at the time, he was building a new $400,000 home. Okay. He heard about what I did. Okay. He heard about what I did for a living. And he says, I'm building this $400,000 home and I put enough down so that I only owe $400,000. All right. And I have an extra $100,000 to put down on the loan so I can avoid PMI. How many have heard that, if you put enough down, you can avoid PMI? And how many of us work to do that so we can avoid that PMI payment? Have you heard it? Huh? Have you heard about it? Yes or no? Come on. I've heard about that. So he says, he asked, so I put the $100,000 down so I could refinance the $300,000. BJ Wims Rosario. How are you doing, Miss BJ? I like seeing you in here. 100,000. Okay. And I can get a $300,000 loan at 3% for 30 years instead of 400,000. You want to know what I told him? I told him this. I said, can you afford the payment on the $400,000 loan? He said, yes, but I don't see why I should, because I have this extra 100,000. I can put it as a down payment and avoid my PMI. I can avoid PMI. No, but I told him, no, you want the $400,000 loan at 3%. Guess what? He happened to be an engineer. He's an engineer by training. He worked out all the numbers already. Okay. And here's what we're looking at. I put it side by side. Here's the summary comparison. Borrow on the left side, borrow 400,000. On the right side, borrow 300,000. Look at the payment on the next line. Borrow 400,000. Your payment is $1,686.42. The other payment is $1,264.81. All right. Already the $300,000 mortgage is winning. All right. Let's go down. Let's take a look at total principal paid is $207,111.20 over 30 years. This is what he was looking at. But down, if I put $100,000 down, I go all the way down to $155,331.60. Total repaid $607,000 on the left side for the $400,000 loan. On the right side, $455,000. Don, why would I not put the $100,000 down? Okay. But I need you to take a look at both loans here. They're both 51% loans. Why? Because it's 3%. All 3% loans are 51% loans. The bank doesn't care. Okay. They're still going to make their money, but they would love it if you give them the $100,000 up front so they can lend it back out again. If you know anything about fractional reserve lending, meaning that for every dollar the bank has on deposit, they can lend out $8 or $9 for every dollar. So when you give them the $100,000 back early, they can lend that back out. So, all right. Now, but you also, if you pay it as a down payment, you make the loan look better to the investor. You make the loan look better to the investor if you pay that $100,000 down as a down payment. Now watch what happens. What is the difference between the interest paid on both loans? This is what he pointed out to me. He says, Don, your way is $207,000. My way is $155,000. That's a $51,779 interest savings for me. Period. Over a 30-year loan. $51,000. All right. And he says, why would I not do that? Plus, I don't have to pay a PMI, which is an additional savings. So I said, here's what you do. Take the $400,000 loan, make your first payment here, where $1,000 goes to interest, $680, $642 goes to principal. And then I asked him, where is your $100,000? Because this is closed now. This is closed. This loan is closed. Where's your $100,000? He says, it's in the bank, Don. I didn't put it as a down payment. So what do we do now? What did I say? What do you guys think? Here it is. Now apply the $100,000 to principal. I need to show you what happens when you apply it as a prepayment instead of a down payment. And I'm telling you, folks, this works on your mortgage, your student loans, your credit cards, all of the loans. If in order to save interest, there's a way to do this thing so you don't have to give the bank all of that money. Watch this. On his amortization schedule, I showed him, it takes him all the way down to line 125. If he puts it as a down payment, he gets a $300,000 loan and he starts out at payment number 1 and he avoids the PMI, the private mortgage insurance. Okay, he doesn't have to pay it. But if he gets the $400,000 loan, and with his first payment, pays the $100,000 with it, he starts out on his $300,000 loan. Look at this. He's at $300,000 right here. He's still at $300,000, but he starts out on line 125. Folks, does that make a difference to you? Does that make a difference to you that he can start out on line 125 of this and still have a $300,000 loan? Wow. And how much interest did he not pay to get it to this point? $110,000. $110,000. That's what he paid. Didn't pay. Now, $110,000, and he knocks 10 years, 3 months of payments off the loan by prepaying the $100,000 instead of putting it as a down payment. It's still a $300,000 loan either way. He still gets his 20% down, but he's putting the rest of the money as a 20% down after the loan closes. So he will have to pay PMI for 1 month, and then he can apply to have it taken off because he's still at 80%. What do y'all think? What do y'all think about that? So here's what I need to show you. Is he saving that money now? Or as somebody has said earlier today to me, is that coming off the back end of the loan? Do you have to keep the loan for all 30 years to realize that savings? I'm going to show you the math right now. Okay, let's take a look at the math. All right, so we're going to get out of this. I'm going to put an amortization schedule on the screen, and we're going to go over the math. All right. So let's bring that back up. I've got my amortization schedule on. You guys are looking at it here. We had a $400,000 loan at 3%. There it is, 3%. Now, this was a while ago. We can't get 3% now. Okay. But let's take a look at this. We're going to delete that. Okay. Now, this is our payment here, $400,000. And then we're going to put $100,000 down as a prepayment on this loan. So if we prepay $100,000, we scroll down, we keep scrolling, we keep scrolling, we keep scrolling. And to pay $100,000 on this loan naturally, all right, it takes 125 payments, and we're down to here. Let's say we take it all the way down to $229,000. Okay, 229,000 for 424.31. All right. So now we're here. So we're going to take this number. All right. This would be our new balance. If we prepaid the $100,000 in 1 month, here is our new balance. And we get here in 1 month. Does anybody disagree with that? This is how much we owe when we just prepaid the 100,000. So now let's take a look at this. We're going to copy this. We're going to bring up a whole new amortization schedule. We're going to open a new tab. All right. And we're going to put our new loan in. Okay. Paste that. And we're still at 3%, right? But we don't have 360 payments left anymore. So we're going to let the calculator fill that part in. So here's how much here is the new. I forgot to put the payment in. Sorry, my fault. It's 1199.10. Boom. All right. Now we can calculate and gives us how many payments. Wait a second. That's not right. Sorry. Let me go back. Our payment is $1686.42. Copy that. $1646.82, because the payment doesn't change. We already read about that. Here's our same payment, because the payment doesn't change. So how many payments do we have left now? 235 payments. I need you to see the math on this. Okay. And I'm putting a calculator on the screen. All right. There we go. All right. So the math here says if I have this loan for 30 years, all right, I will pay $207,111.20 on this. But now what do I have left? I only have $96,882 left in interest. Because I made a large prepayment front. So I can't have $207,000 worth of interest left. When I put this new number in an amortization schedule, I only have $96,882 left. So if I do the subtraction, here we go. All right, so let's put it in. 207,111.2. And I'm going to subtract 96,882. That's how much I have left. Okay. I'm going to subtract 96,882.01 equals 110,229.19. I just eliminated 110,229.19 from this loan by prepaying the $100,000. And if I look at the amortization schedule, the original amortization schedule, and I go down to $100,000 here. Look at this. Let me put the calculator back up. 110,229.19. 110,229.19. Look at here. This is practically the same amount of money. Look at that. Look at that. Ladies and gentlemen, I just wanted to show you that by prepaying that money, you save a ton of interest by looking at the two loans side by side. Whenever you prepay, you've got a brand new loan. And to pay down to that point means I don't have to pay the bank all of that interest. Does that make sense to you? Does that make sense to you? So never put a large down payment on a loan. Take that money and make a prepayment. All right. So if you're in real estate, if you are a real estate agent, and your client says, you know what, I got this extra money, pull up Brett Whistle and find out if they can make that payment. If they can make the payment, tell them about that. They can take that money and knock off a ton of debt. Can I go back and show you? I'm going to put back on my PowerPoint, and we're going to show you the rest of this. All right, there it is. If you're new to the room, go to YouTube so you can see this. Okay, this is what I showed them. We saved over $110,000 here, ladies and gentlemen. $110,000. That's in interest, and eliminates 10 years and 3 months of payments by putting it as a prepayment instead of a down payment. Can anybody argue with the fact that if I'm going to use $100,000 of my money, does it do more work for me as a down payment or as a prepayment? Put it in the chat. If I'm going to pay my $100,000 down, which way does it work more for me? Down payment or prepayment? You decide. You saw the numbers. You tell us. Okay. I just knocked off 10 years, 3 months off this loan. And you now have only 19 years, 9 months left. What? If I put it down as a down payment, I have a whole 30 years left. A whole 30 years left. But if I put it as a prepayment, I only have 19 years, 9 months left. Does that make sense? I love doing this part. Listen, folks, there's no reason for us to go into the new year and not understand how this works. I need you to watch this over and over and over again and tell others to come in and watch it too. Okay, watch this. So what else happened? What else happened? So we're going to continue. He signed up for the P.I.L.L method. By continuing to use the P.I.L.L method, he will pay the rest of this loan off in 7 years. And total interest that he will pay on this loan is $30,000. That's it. That's it. Guess what? I'm his new best friend. I love doing this. I love doing this. Any questions? Come up to the stage, ask some questions about what you've learned today. Because listen, we went over how to read an amortization schedule. We went over how to prepay. We went over refi fantasy. Okay. What we didn't go over is this. What if I have come in as a 8% loan? What if I have an 8% loan? And then should I refinance to a lower interest rate when the interest rates drop to 6? What happens when we do? Can I show you that is, if you can afford the payment, can I show you it's actually easier to pay off your loan at 8% than it is at 6? If you want to see that, put a number 9 in the chat and I'll show it to you. If you want to see that, put a number 9 in the chat. If you can afford the payment. Now, I understand if you can't afford it, then you got to do something about it. But if you can afford the payment, you're better off staying at the 8% instead of refinancing it down to 6. Oh my goodness. I see the number 9s coming in. All right. And listen, show your friends this. Show your friends this because they're hearing. Here's what they're hearing: marry the house, but date the rate. Refinance when it's lower. Oh, come on. We can't keep giving this advice and listening to the advice when people aren't showing us the math to show us why we should do it. It just sounds like we should, but nobody ever, listen, has anybody ever showed you the math on that? Admit it. Just think about it. No, it just sounds like we should do that. But nobody showed us the math on how it is actually going to help us. No. So let's get into it. All right. So I'm going to get out of this, go back to our, all right, bring up our amortization schedule. Okay. All right. So the median home price in the United States is $420,000 right now. 420,000. And we're at, let's say we got that loan at 8% about a month and a half ago. Because listen, it was at 8% then. Okay. So here's my payment and I can afford it. It only makes sense if you can afford it. And I'm affording this. I need you to see what's going on with this $420,000 payment. 300 and it's $3,081.81. Look at this. Look how tiny the principal payment is. $281.81. Look how much goes to interest. Write it down, folks. Write it down. Control the principal payment and you control this loan. Control the principal payment and you control the loan. Interest payments you skip don't matter. Interest payments you skip don't matter. Okay? All right. Interest payments you skip don't matter. Here's what we're looking at. Remember in the beginning where if you make your payment here, you make your full payment on line 1, you can prepay this number. I'm just picking out a number. On line 2, it's $283.69 is your principal payment. You prepay that. Also, give that to the bank in the first month. You don't have to pay them the $27.98 in interest. You're paid down to line 2 in the first month, and your next mortgage payment is on line 3. Look at that. Look at that. Watch this. Cumulative principal and cumulative interest. Remember, this is why we use Brett Whistle. Make sure you go to Brett Whistle in the chat. I'm going to put it in the chat again for all the new people. This is what we use for a teaching tool. You need to run these numbers for yourself so that you can see. So I'm pasting it in here. Boom. And I'm going to put that back online as well for everybody who's online. Okay. Come on. There we go. And we're going to paste this in here for everybody that's online. Uh-oh. Brett Whistle. All right. Come on. Get that out of there. Delete that. All right. Copy and paste. Come on. I'm trying to paste it in here. That's for you guys online. Brett Whistle. And we're bringing it over. Come on, come on, come on, come on. It's not bringing it over. Paste again. There it is. Now you got it. All right. So there it is online. So you guys can use this. You can use this as well. Okay. So let's bring back my, let's bring this back. There it is. Okay. So now we're at $281.81. If I take a look at cumulative principal here, I paid down this loan by $3,508.52. $3,508.52. I can prepay that and knock off 1 year's worth of payments, couldn't I? I can prepay this because it's all the principal payments added up. Do you see that? If I add up all the principal payments, it comes to $3,508.52. I add up all the interest payments for 1 year, it comes to what? $33,473.20. So in other words, it costs at 8%, it costs $33,000 to pay this mortgage down by $3,500. I don't want to pay that. If I have the $3,500, if I have it, I can prepay that, knock off a year's worth of payments, and I save a ton of interest. Does that make sense to everybody now? I sure hope so. But what if I lower the interest rate? Okay, so I'm going to duplicate the tab. I'm going to duplicate this tab, and we're going to lower the interest rate. We're going to go from 8% down to 6%. Okay, down to 6%. And we're going to calculate that. Here's my new payment, $25.18. Uh-oh, here's my payment. Oh, listen, $30.81 down to 6% is $25.18. Okay, so if I'm not looking for a lower payment, but what I am looking at is, how do I avoid paying the bank a ton of interest? How can I avoid that and pay off my loan faster and cheaper? Okay, watch this. My payment now, look at my principal payment. Instead of $281, this is at 8%. At 6%, look at my principal payment now, $420. I got to come up with $420 now to knock off one line. Would you have believed it if you didn't see it for yourself? At the higher interest rate, because my $3,500, I can divide many more $200 payments into this $3,500. I can knock off 1 year. But if I take $3,500 at the lower interest rate of 6%, I put $3,500 on this loan. Look, it only knocks off about 8 payments. Look at that. Has anybody ever showed you this before? If the answer is no, put a no in the chat. No one has ever showed us this before, anywhere, at any time in our entire lives, no matter what kind of financial education we have received. This is the first time we've seen this. Okay, no one has ever showed us this. And folks, I'm not taking credit for it. I'm telling you, there's actually no reason for me to know what I know. I did not wire my brain. I did not wire myself to have Asperger's or autism spectrum disorder. When I look at an amortization schedule, this is what I see. And for the past 18 years, I've been trying to develop the verbiage to help other people understand what I see when I see an amortization schedule, because no one else is teaching it. I did not sit down and say, you know what? Let me figure out the best way to pay off a loan. Listen, I was a firefighter for 17 years. I was a firefighter and EMT for 17 years. Trying my best to pay off my bills just like everybody else. I just happened to take a look at an amortization schedule, and something drew me to it and says, listen, something about this doesn't look right, because I'm paying all this money and look how much money is going to principal. Look how much money is going to interest. And started looking at, and no one had any information on how the thing actually works. Couldn't find it anywhere, but it didn't look right to me. And after playing around with it and discovering more and more stuff about it, we have the P.I.L.L method today. So I quit my job as a firefighter after 17 years. We're in Michigan, where I was a firefighter. You have to stay in for 25 years to draw retirement. I don't get a retirement from that. We started this business to teach people here, and I started it in 2006. I quit firefighting in 2007 and haven't looked back. This is all we do, helping people to understand how to do this. And we developed a cloud-based AI computing system that does all of the math, that shows you how much to pay and when to pay. If you want to know how the AI system works, if you want to know the month, day, and year you can be debt-free, then get a savings and earnings report today. I'm going to put my link at the top. Now, you have enough. Listen, I've got 2 years worth of stuff of this kind of data on YouTube right now. There's enough free information for you to save a lot of money and save a lot of time. But if you want to save the most amount of money and the most amount of time, then you want to plug this stuff into a computer because there's so much math involved. You want to pay the right amount in the right month on the right day of the month so that you can eliminate the maximum amount of interest per dollar. So let me pin the link here. It's ice10k.com. ICE, the number 10, the letter K.com. There it is. And that should be at the top of the page. I'm also going to add it to, let me see here. I'm also going to add it to our banners here, ice10k.com. We're going to have that crawl across the screen. So you want to go to ice10k.com and get a savings and earnings report. So when you click on that, let me bring that up, ice10k.com, ICE. There we go. ice10k.com. There it is. And this is what you see when you bring that up, ice10k.com. And if you scroll down underneath ET's picture, Dr. Eric Thomas's picture, you will see get a savings and earnings report. Click on that button. And it says, get your free savings report. You can know the month, day, and year you're going to be debt free on your mortgage, student loans, credit cards, everything based on your current budget, and we'll give you the report for free. Fill out the information. It's a 2-step process. All of your information is here. My team will get that information, call you to verify the information. Once it's verified, we will create your analysis, and you will know the month, day, and year you could be debt free and how much interest you will not pay the bank. If you want to know how to implement our program and to get our opportunity cost calculator and see how much extra interest you could save, Lord have mercy. Oh, more interest and more time. We will go into that more in depth with you. You can get a consultation. Our consultation is only $150. You get a whole hour, $150. But even the consultation is guaranteed. If you tell, and you're most likely going to talk to me, if you tell me before the end of that call, Don, thank you very much for the information, but I don't think it was worth $150. Before you get off the phone, I will send it right back to you. Then that's a promise. All that we do is guaranteed. We do what we say or you don't pay. Nothing. You'll never feel like you got stuck ever with the P.I.L.L method. All right. So if you want to get that, know more about it, then get your savings and earnings report. Okay. So what else do we have for you before we get out of here today? Because remember, I told you it's my wife's birthday. She's waiting to go out and do her thing. Okay. So we're going to go out shopping and go out to eat. We're going to do a whole bunch of stuff. It's just going to be her day. Her day. Okay. So here's what we're doing. Get my book. Here it is. Oh, before we even get the book. All right. Become an affiliate. Some of you have learned so much about this. You want to tell other people about it. I would love for you to tell other people about it. I need you also follow me. All right. Become friends with me and follow me. Click on my bio and join the P.I.L.L method, the P.I.L.L method house. Okay. Join the P.I.L.L method house so you'll know whenever we're on, we can give you more information. Join that, do all of that, and follow me on social media. Okay, do that so you can get that information. Also this, become an affiliate. If you click on become an affiliate, this is what it looks like. Name, phone number, email, and you pick how much and how you want to get paid. Here's how easy, you don't even have to sell anything to become an affiliate. So when you become an affiliate, you will not get a notice. You will not get a notice instantly when you fill that out, because it only takes about 15 seconds to send it in. In about a week, you'll get a notice, because we send out a notice to all the new affiliates all at one time. And we give you some instructions on what to do. It's as easy as this, ladies and gentlemen. Find someone who's tired of doing what they're doing. They're tired of, listen, we're not trying to convince anybody to change their ways. Please don't. I only want to talk to people who are tired of doing it the way they've been doing it. They want to do something different. They want to do something better. They want to do something new. Okay? Send them to the YouTube channel and let them watch the videos for a couple of weeks. A couple of days. Call them back within 48 hours and ask them if they want more information. If they do, go back to my card, the ice10k.com. Go back there. Okay? Scroll down underneath my picture, which is right here. Scroll down underneath my picture and you'll see refer a friend. Fill that out. Okay? Takes a few seconds to fill that out. And don't forget to put your name and your phone number here and any additional information that we might need to contact that information of that person, and click submit. When they become a client, we'll pay you $300. Yep. You send us 2 in the same month that become clients, we'll pay you $400 for the second one. It's a total of $700. You send us a third one in the same month, we'll pay you, let's see, that was $300, $400, $500 for the third one. Okay. 3, 4, 5. You send us a fourth one. Oh, that one's worth $600 if you send us a fourth one in the same month. Send us a fifth one in the same month, I'll pay you $1,200 for that one, for a total of $3,000. Anywhere from $300 to $3,000 a month. Just for sharing our YouTube channel with someone and then sending that information to us. You don't have to do anything else. And we'll pay you. Okay? Nike doesn't even do that. Nobody pays you to listen. Share this information with people and get paid. Okay? Because I can't talk to everybody. I don't know everybody. You know about 250 people each. And some of those are tired of doing what they've been doing. Help them, and then I'll help you. How about that? Okay? So become an affiliate. All right. And we'll send you the information. Takes about 15 seconds to fill out. Let's go back. Remember, get that button down here, become an affiliate, and also get my book. There it is. Click the button, get the book, and start learning about the P.I.L.L method along with watching the videos, so that you can feel more comfortable with sharing you don't have to explain anything, and please don't. Just feel more comfortable with it as you read the book. And you can teach this to your kids. You can teach this to your grandchildren. You can teach this to your nieces and nephews. I mean, the young people need to know this. I mean, I teach this to 8th graders and they eat it up. Can you imagine 8th graders wanting my book about finance? Yeah, it happens all the time. All right. I love talking to young people, but you can teach this to young people as well. Get the book. All right. So let's see where my book is. There's 33 million titles on Amazon today. Oh, out of 33 million titles, my book has dropped down to 113. Let's get it back up to number 1. Okay. But out of 130, it's right here. 113 on Amazon. But ladies and gentlemen, that's still not bad out of 33 million titles. Okay. So I'm not complaining. The book is still selling. So get that. And there you are. There you have it. I want to thank everybody for being here today. Let me check and see. Are they? It says Steve Mack. How can we access this episode? There's replays on Clubhouse, and it's on right now. It's on YouTube. Right now, it's on YouTube. Right now, it's on Facebook, Twitter, and LinkedIn. Just search P.I.L.L method, and you'll be able to see all of our social media, and you can find it. Or just go to any social media that you like, whether it's YouTube, Facebook, Twitter, LinkedIn. Search for P.I.L.L method. In those social media outlets, you'll find this video. Okay. And that even today's. Okay. All right. As soon as we're done, it's up and ready to go. Let me see if there are any more questions. I hope this has been, oh, listen, Kim, thank you. Happy birthday to my queen. Happy birthday. But her name is Patricia. Okay. She married me 21 years ago. Love her. We're going out to do her thing today. All right. So anyway, thank you so much. I hope this has been beneficial. I told you I was going to give you the whole truth and nothing but the truth. And I'm going to tell you exactly what you need to start saving money on your loans. Okay. You're going to have to do some additional stuff to figure out which loans to start with, which ones are going to save you the most amount of money. But I promise to give you the basics on understanding how an amortization schedule works. And before the end of this year, we're going to do a whole history on how all of this came into being because of the Great Depression. How would you like to know the history of all of this and why it came into being? Most people think it was to help the consumer. I'm going to show you that history says all of this happened to prop up the banks, not because of us. This whole system uses us as a vital resource so that they can make more money. They lend us money so that they can make more money. That's what this is about. It's about banking. It's about making people rich. It's about us not knowing how the whole thing works, because the first amortized mortgage was in 1936. It was a 20-year loan. Before 1936, there were no self-amortizing mortgages in the US. No. People paid interest only on their loans. They weren't amortized. And they had big balloon payments after 3, 5, or 10 years. They had big balloon payments. And when they couldn't pay the balloon payment, the bank would just reissue the loan and just refi it so they could continue to make interest-only payments on these loans. But when the depression hit, when the stock market crashed, the banks, because the properties lost so much value, the banks would no longer refinance, and people couldn't pay the big balloon payments, and they lost their properties. We're going to get into what FDR did to create an atmosphere so people can pay their mortgages, but investors make trillions upon trillions of dollars with this new system, and it props up the banks, even though we thought it was helping us. So we're going to get into the history on that. Maybe before the end of the year. We're going to get the history of that. Next Sunday, we will not be here because of we won't be here next Sunday to do a live. But if you we're here on Wednesdays, Sundays, Wednesdays, and Fridays. So while we're on vacation, because of the holidays, we'll always have a replay up on Sunday, Wednesdays, and Fridays if we're not here. So some information will be here on Wednesdays and Fridays. It's at 7 a.m. It will be a live broadcast of the replay. Okay. On Sundays, it's at 8:30 Central. On Wednesdays and Fridays, it's at 7 a.m. Central. All right. That's when it first comes on. But, you can always catch the replays. So we're going to have some oldie but goodies as we, enjoy the holidays along with you. But thank you for being here. And Michelle says, happy birthday to Patricia. Thank you for that. All right. Thank you, Missy. Thank you for that. All right. And let me check and see my what's going on, my comments here. All right. Vienna Cochran says, happy birthday to your queen. She put that, look at that. She puts that on there. She says, thank you so much. All right. Let me see here. World Free Hustle says, what if you have interest only payments for the first years? You know, just because your loan is interest only doesn't mean you have to pay interest only. In fact, let me tell you the loan I wish I had. Okay. Let me tell you the loan I wish I had. I wish I had, this is for World Free Hustle. I wish I had a 40-year loan that was interest only. I could massacre that loan if it was interest only and if it was for 40 years, because my principal, my payments would be so tiny. Watch this. Oh, Lord. If you have an interest only payment, your payment is based on the interest calculation on how much you owe. Well, what if you pay money to principal anyway? You don't have to pay money to principal, but you can. If you bring the principal down and they calculate your new payment because it's based on how much you owe, you actually control your payment on an interest only loan. Does that make sense, everybody? Because if I put money on principal and next month I owe less principal, meaning they have to calculate a new payment for me because my payment is based on how much I owe. So I'm going to pay the interest on that amount. So you can put any amount that you want. What if you could accelerate the time? So if you're in the first few years of that loan, and if you have the interest only payment for 10 years, guess what? After 10 years, it becomes a principal and interest loan. Yeah, but you haven't paid anything towards principal. So if it's a 30-year amortization, that means that's now a 40-year loan. But what in the first 10 years, you knock off a ton? What if you knock off 20 years worth of payments in the first 10 years? And then after that 10 years, after that, you only have a little bit left, and you can knock off another 5 off the other 10. You could be done in record time, all on your own, even on a interest only payment. I wish I had one. I love interest only. And if you sign up for a consultation, I can take you deeper into it if you have an interest only loan. I love them. I absolutely love them. Thank you, everybody. I think I said thank you to everyone who wished my wife a happy birthday. Thank you, everybody. I will be back here probably on Wednesday, and then I will announce our schedule for the rest of the month. But before the month is out, before we go into the new year, we will go into the history of the amortized mortgage, where it came from, and why you don't have the information you should have. And if I can teach this to 8th graders, that means you could have learned it in 7th and 8th grade as well, and not be paying the interest you're paying now. So don't forget, get your savings and earnings report at ice10k.com. Get my book, because it's the only book of its kind on Amazon out of 33 million titles, and become an affiliate. Share the YouTube channel and get paid. I love doing that. Love doing that. All right, folks, we're out of here. The last thing you're going to hear from is Dr. Eric Thomas today, the E.T., the hip hop preacher, who actually paid off his mortgage in record time, made his wife feel a whole lot better because of it. And then we're going to be done. We'll see you back again here on Wednesday, and we'll give you the schedule for the rest of the month. Here is Eric Thomas now with his 2 cents about the P.I.L.L method.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.